Namaskar. In this presentation today, we will talk about the external value of the rupee. We will define what exactly is the external value of the rupee and what factors influence the external value of the rupee. The role of India's central bank, the Reserve Bank of India, in determining the value of the rupee will also be discussed. In the end, we will see how RBI plays a crucial role in managing and stabilizing the rupee's value through various interventions. The importance of external value of the rupee primarily stems from three important factors. The first one is global trade. It affects India's imports and exports. A favorable external value can improve India's balance of trade and overall economy. The second one is foreign investment. The external value impacts the attractiveness of India as a destination for foreign direct investment and foreign portfolio investment. A stable and favorable rupee value can boost investors' confidence. Third one is macroeconomic stability. The external value of the rupee influences inflation, interest rates, and the cost of living in India by affecting the price of imported goods, especially commodities like crude oil. Now let's define the external value of the rupee. The external value of the rupee refers to the exchange rate of the Indian rupee (INR) relative to foreign currencies, particularly major global currencies like US dollar, the euro, or the British pound. It reflects how much of a foreign currency can be exchanged for one unit of the rupee and determines the purchasing power of the rupee in international markets. Reserve Bank of India. While the external value of the Indian rupee is shaped by market dynamics, the Reserve Bank of India actively maintains it through interventions, reserve management, monetary policy, and regulatory oversight. The Government of India works in coordination with the RBI by formulating policies on trade, foreign direct investment (FDI), and fiscal management, which influence the rupee's external value. For instance, policies to boost exports or reduce import dependency can help strengthen the rupee over time. Now let's discuss one by one what are the factors which influence external value of the rupee. The first and the foremost important is exchange rate system. India operates under a managed float exchange rate system. This means that while the value of the rupee is determined by market forces, the Reserve Bank of India (RBI) intervenes occasionally to stabilize or influence its value when it becomes excessively volatile. Demand and supply of currency. Another factor is demand for Indian rupees. Foreign entities need rupees to invest in India, buy Indian goods or services, or for remittances. This increases the demand for Indian rupees, leading to an appreciation. Supply of Indian rupees. When individuals or business purchase foreign goods or services, invest abroad, or pay for imports, they need foreign currencies, increasing the supply of rupees and causing its value to fall. Continuing with the factors influencing the external value of the rupee, another factor is inflation rates. Countries with low inflation typically see their currency value rise, while those with high inflation experience depreciation. If India's inflation is higher than its trading partners, the rupee might lose value. Another factor is interest rates. Higher interest rates in India attract foreign investors looking for better returns, increasing demand for the rupee and appreciating its value. Conversely, lower interest rates can lead to depreciation as investors seek better opportunities elsewhere. Foreign investments. Foreign direct investment or FDI. When foreign companies invest in India, they need to convert their currency into rupees, which increases demand and strengthens the rupee. Foreign Portfolio Investment or FPI. Similarly, foreign investments in Indian stock and bond markets influence the rupee's value. Continuing with the factors, current account deficit. A current account deficit occurs when a country imports more than it exports. A large current account deficit means India needs more foreign currency to pay for imports, leading to a greater supply of Indian rupees in the market, which depreciates its value. Foreign exchange reserves. The RBI's foreign exchange reserves act as a buffer against currency fluctuations. If the rupee depreciates too much, the RBI can sell foreign reserves to buy rupees and stabilize its value. Geopolitical and global factors. Political stability, trade policies, and global economic trends can affect the rupee. For example, global oil prices, as India is a large oil importer, can have a significant impact on rupee's value. Global events like economic slowdowns, wars, or pandemics can also influence the rupee as they affect investor sentiment and global trade flows. Speculation and market sentiment. Currency traders and investors may speculate on the future value of the rupee based on news, economic data, or geopolitical developments. This speculation can create short term volatility in the rupee's value. Now let's see how RBI manages the external value of the rupee. The external value of the Indian rupees is primarily maintained by the Reserve Bank of India or RBI. While the exchange rate is largely determined by market forces in India's managed flow system, the RBI plays a crucial role in managing and stabilizing the rupee's value through various interventions. Interventions in the foreign exchange market. The RBI actively intervenes in the foreign exchange market to prevent excessive volatility or rapid depreciation or appreciation of the rupee. It does so by buying or selling foreign currencies, typically the US dollar. If the rupee depreciates too quickly, the RBI may sell its foreign reserves to buy rupees, thereby increasing demand for the rupee and stabilizing its value. If the rupee appreciates too quickly, the RBI may purchase foreign currency, increasing the supply of rupee and curbing its rise. Maintaining foreign exchange reserves. The RBI holds substantial foreign exchange reserves, which act as a buffer against currency fluctuations. These reserves can be used to defend the rupee during periods of high volatility or external shocks, such as global financial crisis or sudden capital outflows. Managing external shocks. The RBI may take specific steps in times of global financial crisis, trade disruptions, or sharp changes in the global commodity prices, for example, oil prices, that might affect India's current account deficit and thus the value of the rupee. Regulatory measures. The RBI also implements capital controls and manages the inflows and outflows of foreign investments to maintain financial stability and prevent undue pressure on the rupee. Coordination with the government. The Government of India works in coordination with the RBI by formulating policies on trade, foreign direct investment (FDI), and fiscal management, which influence the rupee's external value. For instance, policies to boost exports or reduce import dependency can help strengthen the rupee over time. In summary, while the external value of the Indian rupee is shaped by market dynamics, the Reserve Bank of India actively maintains it through interventions, reserve management, monetary policy, and regulatory oversight. So please let us know in the comment section how you found this presentation. Please also subscribe to our YouTube channel. Thank you very much.